On the flip side, I keep thinking about, like, what would it be like if I announced things to my family via Twitter? Hello, everyone, and welcome to Housing Insiders, the podcast for founders, builders, lenders, and regulators, and anyone who believes that everyone should be well-housed. I'm Jonathan Lawless.
And I'm Jeremy Potter. On Housing Insiders, we're hosting the conversations you won't hear anywhere else about how to make housing more innovative and attainable.
And we're super excited to partner with Bilt Rewards this time to bring you these smart conversations. If you have an idea for a guest or a show or have an interest in sponsoring an episode, email us at podcast@thehousinginsiders.com.
And if you like the show, please give us a review, share it, spread the word so that we can get more podcasts out there in your feed and on the topics you care about.
And every now and then I get a chance to go out to the great state of Michigan and hit up the city of Detroit and hang out with my friend Jeremy. He and I were doing that last night, and we were thinking that we would record the podcast while we were together in Detroit. But I think about 3 beers in, we realized that our conversation probably would not be as interesting to the rest of you. So we're doing this remotely again, but we certainly covered a lot of topics yesterday and are excited to talk about them.
That's right. Every now and then we like to do one of these episodes where it's just you and I, John, and we kind of tackle current events, breaking news. I think today especially we're seeing a lot more announcements on social media, so we'll do a deep dive there. So hopefully some of our enthusiasm from being together in person will carry over, and the audience will appreciate the energy we're bringing today. I like to describe today's episode as a value meal of topics. I don't know if that's the right way to think about it, but we have an announcement this week from Bilt, which obviously, John, I'll throw it to you to talk a little bit more about that. We had an ADU bill drop, I think, last night. So this is truly, you'll hear this in about a week, but it's truly breaking news and will still be a hot topic then. And then we have a couple of those posts, especially from the U.S. Federal Housing Director, as he titles himself on Twitter, Bill Pulte, and we'll get into a lot of what's going on at Fannie and Freddie, what this policy looks like, what it means to you. So some of those exciting topics like crypto and mortgages, I think, John may laugh at me for calling it even exciting, but it is something people care about. It is something people click on, so we want to explain it. We've got more details on VantageScore and FICO and the competition there, and then maybe we'll have some time to jump into some of the macroeconomic issues that we're seeing pop up. There's a lot of chatter about interest rates going up or down, how to get them to go down, as well as what housing prices mean. We're seeing builder news, we're seeing housing price news. So hopefully you'll stick with us. That's all we're going to get to, and we'll have some thoughts, insights, and laughs along the way. So John, I'm going to send it back to you on the Bilt thing. Tell us a little bit more about what this announcement was, and we'll go from there.
Yeah, absolutely. I mean, I'm excited about this episode because so much is going on. Very close to home for me, of course, is the announcement from Bilt. We recently did another funding round of about $250 million, which skyrocketed our valuation to close to $11 billion, which for a company that's been around for 5 years that has 200 employees is just amazing. I've spent a lot of time talking to folks in our industry about what it is that Bilt does and why this is so exciting. And oftentimes I think people really don't understand fully the Bilt model and how we operate. But what I can say is, like, when I think about extending what Bilt has done for landlords in the sense of their ability to generate extra revenues, for their ability to increase loyalty to their properties, in other words, decrease turnover rates, to decrease delinquency rates, to increase electronic payments, to increase their retention, it's really been incredible in the multifamily space. And it doesn't take a lot of imagination to sort of translate that to what that would do for servicers. And so we're super excited to start on that journey. And if anybody that's listening, or anybody in the housing industry that's curious about how Bilt is planning on doing this or what we're thinking about, please don't hesitate to reach out to me. I'd love to explain what we're thinking about, what we're doing, how it's working, because I do think there's some misperceptions out there on what's happening. So anyway, super great news from Bilt.
Congratulations. It is. That is great news. And really no surprise to those of us who have been following what you're doing, what the company's building. I think the thing that I'm most interested in, and this goes all the way back to when you and I first met, when we started working together, product development, innovation, is all about adoption. What's the hook? How are you going to get it to be used by either companies or especially consumers? And one of the things that I think has always interested me about product development is you don't always know what's going to be the thing that gets the adoption. You think you can try it and you have to test different things, and then once you find it, there's a hook. Incentives for behavior are huge. They're hugely powerful. And I think Bill understands that, and connecting kind of the incentive ecosystem across landlords, property managers, through to the residents and the consumers, and through to the financing of their eventual move, whether they move within buildings, whether they move within communities, whether they move from a renter to a homeowner. There's incentives throughout that, and stacking them and finding value in them, I've always thought is the way to find adoption. So it's all about adoption, and that's what Bilt has, and that's why you see those numbers.
Yeah, distribution, as we always talk about, for every startup that tries to make it in the housing world, it's just how do you get to your consumer? And then, I think as our CEO says, like once you get product market fit, then you can sort of really expand on the product. But at some point, as you mature, you have the opportunity, the very, very rare opportunity to go from product to platform. And that's the transition that Bilt has made, which is just, so impressive. And kudos to Ankur, our CEO. He's just been tirelessly executing and making this company something that's really extraordinary.
Well, I'm glad we get to keep an eye on it with a front row seat with you as our co-host on Housing Insiders. And then also, of course, as you said, it's coming to the market. It's coming to servicers. It's coming to the mortgage market. And so everyone listening can understand that incentive structure even more. Well, speaking of housing, really core to that is units. How do we get more square footage? How do we create more supply? And so our second topic today, this ADU bill, John, you've worked really closely on this. You're been named to the board of the Casita Coalition. Tell us a little bit more about why this is such an important bill.
When the Casita Coalition had all the success that they did in California, changing some of the zoning laws, and now we're seeing it just happen nationwide, the next question was, okay, we've fixed zoning. What are the other issues that are going to be obstacles to people getting ADUs in their backyard? And the one that continually comes up is financing. And financing has kind of a dual role. One is just the obvious, which is like it's easy to get financing. The rates are reasonable and accessible. So that's one core role. But I think, what we see with Fannie and Freddie in terms of what they do in providing liquidity and financing in the first lien market is they also create a standard and a comfort level for the market. And so one of the benefits that I hope to see with this latest announcement, which effectively is a bill that's looking to get both FHA and Fannie and Freddie to introduce second lien programs to do financing for ADUs. But the hope is that those companies can now start to set standards that will help others understand, okay, this is how I do an ADU. So it doesn't mean that everybody who wants an ADU suddenly has to become a developer, figure out the construction partner, figure out the financing type, make all the numbers work. It just hopefully will take the burden off of the consumer, which, as you know, putting the burden on the consumer is the stupidest way to market a product. And so this is really, I think, a huge step forward. And I just have to give a huge shout out to Representatives Accardo and Gabarino from California and New York, respectively. These guys have gone out there, have brought a lot of people together, have introduced a bill that I think is going to be incredibly important in creating more units.
I just want to be a little bit more granular on homeowners out there, and what, if you're a lender listening, if you're a real estate agent listening, if you're somebody who produces ADUs, what this really ties together. And I just want to ask you and make sure that I'm super clear. A homeowner would then go to the GSEs and get a second lien subordinate to their first lien GSE mortgage, which at this point is likely to be under 4%, given the percentages that we see across the market of how many people got a Fannie or Freddie loan at that time. And you said FHA too, so it'll be a little bit higher on the rate on the FHA, but right in that same ballpark, under 4 probably. And you use the equity that you've earned since you've been paying down your mortgage and your property value, which is probably appreciated in the last 3 or 4 years, as we're going to talk about later, and borrow against that to place that ADU in your backyard, and then use it for whatever you want. It might actually be income producing if you rent it out. It might actually be your office or some other use, but that would just become similar to a second lien product, like a HELOC or a HELoan, but directed specifically at adding that ADU, and then standardize that measurement for all GSE and FHA first lien lenders.
You nailed it. That's exactly right. Exactly
Excellent.
Right.
That's exciting. I know one of the things that I thought was interesting as we've been talking about ADUs over the last few years is, calling them different things in different places. In California, ADU is really strong as a message. In Michigan, they're called carriage houses from back in the day when you had like a horse that needed to be out there before you got the garage with the car in it. You hear about it in different parts of the country, but detached accessory dwelling units, attached accessory dwelling units, I think is a huge way to think about the evolution or the evolving of your property, especially when you don't want to move or you don't want to lose your first lien position because you really like your low rate. So
yeah, the evolution of this product has been really incredible to watch as there's kind of more varieties, more use cases. The use case that I find really compelling, I mean, I'll mention two. Like one is, let's say you have an aging parent or you have kids that want to move back home or can't afford to live in the city because home prices are so expensive. Like this creates a way for families to be able to sort of live in the same place, but not to have to live in the same house, which I think is awesome. But then you also have people that might be sitting on a 40 LTV loan, but their property insurance or property taxes going up. And so they're struggling to make their mortgage payment on their first lien. And now they can go and create an income generating asset. Of course, they do have to take on additional debt, but the hope is that income generating asset more than compensates for that new debt, brings them liquidity, and in some sense de-risks a lot of the first liens that we have out there today that might be struggling with these increased costs. So really interesting use cases, interesting types of homes, interesting names for it. I think some of these need to be more consolidated and crystallized so they can be marketed to consumers better. I think that's something, Jeremy, you and I talk about all the time. Anytime you have an acronym for the name of a product, you're shooting yourself in the foot at the get-go. So there's more work to be done, but again, huge step forward here.
And one of the things I'll just mention on that marketing side and that product positioning side, we do hear all the time from real estate agents and mortgage loan officers, mortgage pros, what else can I be doing? What else can I be selling? What else can I be educating on? How do I become a better advisor to my customers, former and my future customers that I'm trying to enroll? And this would be a great example. You can look back in your book of business and say, who's a likely candidate for this? For all the reasons you mentioned, reach out to them. Hey, I can add value, to your property, to your lifestyle. This is the type of thing that if you're a mortgage pro, if you're a real estate agent, you're looking for those things to be calling about, to do a more personalized campaign than just the typical outreach from the CRM drip campaign. This is the type of thing to be watching. You should be posting about this. You should be talking to your clients about this, because this is the type of legislation that could fundamentally change the outlook of your business.
Yeah, and just as a thought for those lenders who are interested in exploring this, there are some technology companies out there that are using satellite imagery to identify the lots that are most likely available for an ADU. And so you can take a list of properties that you have loans on today, run it through this, and it will identify where the highest and best opportunities are. And now you can really target some of your offerings on a sort of second lien for ADUs to the exact right person that can do it.
Yeah, and whatever you think about the solar panel sales process, one of the things I learned from looking at solar panel additions to houses over the years was you can actually track almost like concentric circles. When the first one arrives in a neighborhood or a community, you can watch others pop up. Again, partly due to the sales and the packaging and the marketing, but also partly because when somebody sees it and sees it work in their neighborhood, they know they can do it. And it wouldn't surprise me if that's exactly what we'll see just from a buying pattern of ADUs. You see one go up, you talk to your neighbors, you understand that it's doable in your neighborhood, and you start to see from that first one sort of concentric circles of sales. And that's exactly what real estate agents and mortgage people are telling us all the time they want. More reason to reach out and be local in their community. So it should work for everyone.
Yeah, I mean, interestingly enough, the fourth ADU just went up on my block. And so we call them alley flats here because they back up to an alley in the back of our houses. But exactly your point, people see it getting done. And sure enough, they say, wow, that's a great idea. I need a separate office for when I'm working from home, that type of thing. So I expect to see a lot of that.
Well, I know I'm not allowed to fill in my pool and put an ADU on top of it yet, but maybe someday I can continue to negotiate within my family for the ADU out back here.
Yeah, I don't know if your daughter's ever going to buy into that, but
until
she can't afford a home in Detroit.
So the rest of today's episode, John, we were kind of going to stay on this topic of current events, of breaking news. And a lot of breaking news is breaking on Twitter, on X, whatever you want to call it, the artist formerly known as Twitter. Director Pulte has been a source of news, particularly around policy guidelines. And so I wanted to kind of talk through and maybe at a high level, get your feedback on just sharing information this way. So just using platforms, we talk a lot about wanting public officials, particularly housing officials, to be bold. We're excited about bold activity. We're excited really about any activity, frankly, that's forward moving and positive. But then there's always the complexity, and there's always the voices that come in and say, well, hold up, it's not that easy, it's harder. And then we get mired back in the same things that have been obstacles and barriers for years and years. And we turn around and policy hasn't changed for a decade or more. And so with this, I just kind of get your feedback to start, and then we'll dive into the specific topics. But what's your take on pushing policy guidelines out this way, pushing the industry this way, pushing the agenda of the administration, any administration, this way?
Yeah, it's a very interesting tool. And as I said, I think in our last episode with Keenan, in some ways, tweeting and shocking the system and disrupting in that way, trying to see the bright side of that, can be kind of healthy for a system that isn't used to change, and creates so much chaos that in some ways that chaos can ultimately lead to some resolution that's positive, versus the traditional, like, we're going to put out for comment a new proposal that we'll have 90 days to get everybody's thoughts on, and then we'll have 733 meetings and hearings, and then put out a rule for comment again. That sort of thing we've seen in the past, and ultimately by the time anything gets done, the whole purpose of making the announcement is probably passed, because the whole world has changed in 5 years. So I think there's a positive to that. I mean, on the flip side, I keep thinking about, like, what would it be like if I announced things to my family via Twitter? And I'm pretty sure they would hate it. There's certainly that shock factor is not going to breed a lot of love and loyalty, especially if it's framed in a bad way. But I mean, I think that's everyone's kind of opinion, is like, this feels so chaotic, and how can you make an announcement without having first talked to everybody about what you're trying to do? I understand the frustration, but again, I think I fall more on the side of, like, I am a chaos lover, and I love that it produces action more quickly than the other paths.
Yeah, I think it's really tricky when you start talking about process, because especially as a lawyer and what we learned in law school, there are many aspects of process that are really important. But what we've also seen, and you and I have complained about it for a long time on and off the podcast, is process can sometimes overwhelm the outcome. And all of a sudden, all we're doing is process all the time, and it becomes so burdensome that you don't even get to the outcome. You don't even get to any activity. And so you need some process. And whenever you're talking about these kind of balancing acts, whether intellectually or literally, it always isn't as exciting for people, right? Like, you're like, oh, you need some moderation, but not too much moderation. And so it always kind of creates these tricky situations where it's like, well, I'm asking for some process, but not too much. And so you kind of, sometimes you just have to challenge the existing norms. And so I will say that's one thing about this that I've been super interested in, is challenging existing norms. And we'll talk about that with specifically the credit score, VantageScore announcement, crypto as collateral for mortgages to it. So if you're listening for those two topics, they're coming up next. But then also, I think using housing and rates as a political tool also then makes this question really murky, because now it's not just about policy and breaking through bureaucracy. Now it's also about politics. And every administration, and probably a lot of people would say everything is politics anyway. You can't avoid it. But I think that's where this kind of universe of must-read tweets and the balance between really interesting challenges to the existing guidelines versus political, it gets hard to decipher sometimes. And I think that's where you see frustration from industry professionals or others on LinkedIn or Twitter. But I also think it's never going to be perfect when it's this tricky balancing act.
Yeah. What are some of the tweets that you particularly thought have gone too far into that, to the other side of the political?
There were two really political tweets, and this, I think, will personify, this will model the difficulty that I'm talking about. One is, the last 200 tweets that I tried to go through, 85% of them were about Fed Chair Powell in one way or the other. And so that's, again, an example where there's a political motivation, always a tension with the Fed, which is why it's independent. There's always a political tension with the Fed. But then turning it personal, I think, is a really tough move for anybody, any administration, whether it's Wall Street fighting the Fed, whether it's an administration fighting the Fed. People will always say, or at least I was always told in the capital markets, don't fight the Fed. That's like one of those rules that everybody teaches you on day one. But at the same time, this is different than that. This isn't fighting the Fed on market movement. This is literally political and job related. So I think that's one side that I have seen, like I said, 85% of the activities on that. And then on the other side, I wanted to talk a little bit about accusing U.S. Representative Adam Schiff from California of mortgage fraud. That one also caught my attention. Those two are highly personal because you're naming people and you're talking about it. But I think it's worth a conversation, if you don't mind, about what mortgage fraud really is, what we're talking about when we talk about mortgage fraud, at least what I know of that case.
Yeah, well, for sure. I mean, I remember early on when Pulte was tweeting a lot about, I'm going to seek out fraud and find it and destroy it and all these things. And yes, there definitely were cases in the multifamily space that I'd heard about, but like in the single family thing, I'm like, what are we talking about here? And then suddenly, you've had now 2 cases of occupancy fraud that Pulte has sort of done in a political way. My guess is every politician now is checking to see if they ended up getting a purchase, an owner occupied or an investor loan on their investment properties. And so it's just, I mean, it's to me, I think there's legitimate fraud I think that they're now legitimately seeking out, and Palantir's partnership with Fannie Mae and some of these other things. And then there's these more gotcha on the political side. That feels like what it means for Adam Schiff. I mean, also, I think they're sort of witch hunting for like fraud on the Fed, specifically for Powell. So I don't know. What are your thoughts? Does this kind of fraud hunt have ramifications? Is it going to do something to housing? Like what should we be paying attention here?
Yeah, the one about occupancy fraud that kind of lit up my curiosity was, I think occupancy fraud is mostly unintentional and accidental in many, many cases. Now, those doing quality control and risk assessments on mortgage portfolios will tell you there's a good bit that's not. I'll give you a really great classic example from my career. A family with a 600,000 square foot house buys a 1,500 square foot house next to a college campus, and it's owner occupied. and the reality is it's actually for the kid. The kid is going to live in the house next to the university. Maybe they'll rent it out to 3 or 4 roommate friends, and the parents just want a safe investment with a safe place to live for the kid. But the way that mortgage applications get filled out, it defaults in a lot of systems to owner occupied, let's say. There wasn't truly a moment, I don't think, in many cases, and there are some, again, the QC folks are going to tell us there are some that are intentional, but in many cases, it just isn't ticked. It's not asked. So the homeowner in that case, Adam Schiff in this case, when filling out the documentation for a Maryland home when you're a resident of California, just doesn't undo the little switch in the system, and neither does their loan officer. And it's an oversight in many, many cases. And so I think highlighting that is valuable to talk about what is real fraud, but highlighting it only to find out that it's a gotcha moment and it's actually pretty accidental across the industry. We should fix it, but it's not anything that's systemic risk, and it's not anything that's intentionally meant to rip off Fannie and Freddie in a lot of cases.
Yeah. I guess the thing that lenders should take away is that if they're making a loan to any sort of high-profile Democrat, they really need to check the right box.
Check all the boxes before you close that loan.
That's right.
Today.
But I mean, your point is a good one, which is like we should make sure that we do it right, and if it's not being done right, it should be fixed, and that makes a ton of sense to me. But prosecuting somebody for what could potentially have just been a mistake is maybe not the healthiest way to go about fixing the problem.
Yeah, and I think that goes to this broader question you asked, which is, what are we talking about today as we go through these topics? And for us as innovation guys, for the people and the guests we bring on about trying to move housing forward, our tagline, everyone well housed, what are we really talking about? And when I look at across all of this, the question I'm going to be asking is, what does this mean for first-time homebuyers? What does this mean for the market? Do any of these things actually move us forward, and how and why? And so even when we get, to the question of competing credit scores and the frequently asked questions, around them, okay, Is it a big enough thing to move the needle? Are we pushing this thing forward? Are we focused on the right things for housing? And so, sure, interest rates are a massive lever. And so thinking about interest rates, debating who should lower them for what reasons is a pretty typical, normal thing. But for what reason? To what outcome? Are we really going to find that even if Fed Chair Powell is fired, replaced with somebody else, and rates come down, will that be good? What will we see? Who is going to get these homes? So I think that's kind of what I'm always getting at, is like, what are we after here? Are we after like true organic market moving innovation and progress? And if we are, then let's talk about it. But in a lot of cases, it's let's just look for a quick fix that doesn't actually save first-time home buyers in the long run.
And that's such a great point. A lot of people I talk to about like, hey, let's fire the Fed chief and then put somebody in who'll lower rates. Well, first of all, can they lower the long-term rate? It's just a functional question. Even if they can, isn't the reaction that home prices just go up to make up for the decreased cost of the mortgage? And that might be the outcome, in which case you sort of didn't really accomplish anything, to your point, in the sort of longer-term mission. Now, on the other hand, we'll talk about builders later, but like lowering rates might stimulate builders to get back in the market at different price points. And that could be a positive outcome of sort of forcing rates to go lower, and maybe would justify a little bit the decision to try to push for that so hard. I wanted to circle back to the occupancy fraud point, because one thing I was thinking about is like, you know, when you let somebody buy an investment property, do you want to make it hard for somebody or more expensive for somebody to buy an investment property? If you make it more expensive or harder, you're just going to increase their mortgage costs, which they likely would pass on to their renter. And so really all we're talking about is like, should the home be a rental or should be an owner-occupied? And in some ways, we need both rental housing and owner-occupied housing. So I'm kind of indifferent. But then I was thinking a little bit about second homes. The second homes seem to be the most harmful, right? I read somewhere that 55 million bedrooms go unused every night in this country, which is a massive number, right? But like people owning second homes that they never use, it seems to be a really harmful thing for housing and for housing supply. And so in some ways, making it more expensive and really rooting out the issues of people having a second home, just finding ways to make it more expensive to do and less likely to do, that actually could have an interesting, to your point, it could be an innovative way to sort of free up some housing supply that we really need.
I think you're going to see this debate happen in two ways. One, second homes, just as you described them. And two, international investors who buy U.S. homes, leave them empty just as a place. It's a store of value. It's a place that they trust to park that amount of however much that home costs. And so the mix or the complexity for policymakers and legislators is, how do you craft something when you have very little legislative activity anyway to begin with and latitude? How do you craft something that addresses that fact and tries to open up more homes for first-time home buyers, but without just incentivizing the cost of the home to go up? You know, that wouldn't be the intent of the law, obviously, but if you just start making it penalizing by taxes or by other ways, making it more difficult to acquire that property, international investors will just pay more because they're not actually that interested in the home price being low. They need it to be as high as possible, frankly, because they're buying. And if you just say you're not allowed to do that, I think that's also an unintentional way, or I should say it's an intentional way to create consequences that we might not realize, right? That might actually drive capital different places. We don't want to drive it. Like if you can't buy a house here, you're not going to then buy RMBS, right? It's not like actually helping the thing that we are so proud of, which is how safe and secure our housing market and our mortgage market are to international investors. So you have this really tricky thing of saying, I don't want to drive up home prices, but I want to block out these buyers if I can. And so I've been actually trying to think, John, can we learn anything from professional sports where there are actually like luxury taxes and different brackets that teams have to pay? Because honestly, I was trying to learn a lesson to craft some legislation that would help first-time home buyers. But I think all that really happens is the Dodgers and the Lakers and the Yankees just pay the tax and stay the Dodgers, the Yankees, and the Lakers. And so I think we're just going to see that same thing here. Whatever they try to do is going to be too blunt an instrument and is just going to make housing prices go up, and investors will just pay more and charge more for those rentals. or let them sit. And I think that's not a good outcome. So we have to be more thoughtful around how we craft that legislation, but we need to think about it.
Yeah, I mean, the number of legislation that's been passed for good reasons that has had unintentional consequences that have backfired on the good rationale to begin with is an endless list. So I mean, you made an incredibly good statement, and I think that's a very thoughtful way to approach this. So, do you think Jerome Powell has X on his iPhone? Do you think he is following the tweets? Like, what do you think he's thinking about all this?
I would wonder. I know when you have such a high profile job and you've trained for it most of your adult life, looking at that as your goal, I think you probably are pretty aware that public life comes with these types of things. I don't think to be this ready for it, but my hunch is, and this is just for my cinematic mind, is there's probably an assistant. There is a person in the office whose job it is to keep them briefed, and somebody has to sit there, probably a young banker, young lawyer, young person getting their career started by just monitoring social media for the Fed chair. It's my guess.
You know, what I would love for them to do is for them to tweet on Jerome Powell's account the middle finger emoji, "fuck off, bitch," or something.
Yeah.
Get a real Twitter fight going.
It was the National Park Service that had such a creative social media campaign. I don't remember if we ever discovered who was running social media at the national parks, but they did such a great job with all this creativity. So whoever that is, maybe they need to tap into it, pull them over, and see where we can go. Because, hey, if nothing else, we'll get some entertainment out of it.
Yeah, that's right. The Fed could be fun.
That's right.
Well, let's move on. Let's talk about some other tweets. Now, we've covered a little bit the tweet on the credit score announcement, and this is a big deal. It certainly is being discussed in many places. What are you hearing so far, Jeremy, in terms of how people are reacting to the tweet?
I saw a lot of, there are more questions than answers. That was kind of a general statement from whether it was the MBA behind the scenes or just industry professionals, particularly on the mortgage side. The kind of tagline that I saw the most was, "This raises more questions than answers." At the same time, there, I think, was a certain amount of practicality. And I probably said this in our episode with Keenan, but I've learned more since then, which is, vendors always want to make lenders happy. So vendors are going to scramble really fast to try to add this to give lenders the opportunity, which brings me to my first question that came up since these FAQs, John. And it was, well, will I be able to submit multiple scores? Will I be able to look at multiple scores? Will I be able to price this to where I now have to buy 4 or 5 different scores on every loan to see which one I like and run that analysis? And I think there was a piece of this that was still up in the air for a long time, is now kind of coming into a little bit more clear vision, but that is, how are we going to manage if you can only submit a loan with one scoring model? How is that going to lower the cost to lenders if now they have to pull and decide and match different credit scoring models to different consumers? So that was probably the first and most active conversation. What have you heard on that?
Yeah, I mean, this is to continue on the emoji theme. This was sort of like face palm kind of moment when I read the FAQs, which was that it sounds to me like what they're proposing is that lenders can choose what score they want to use at a loan level, which I can't imagine a worse idea, because the one they're going to choose is the better one. And so now you're going to sort of really water down the risk signal of any credit score because it's being sort of chosen in this sort of adverse way. And that's going to make it much more difficult to manage risk. You're going to have to price more because now you've got this uncertainty of like, well, what was the other credit score? And so, you know, my strong recommendation from the time I was at Fannie is like, choose the score at a lender level, not at a loan level. So a lender, let's call it Rocket, will say, we are going to use Vantage 4.0, and every loan that we do is going to be Vantage 4.0. And the advantage of this, first, you avoid this adverse selection issue, but then the other thing that's a huge benefit of that is that now you don't need another field in all of the systems to say what credit score it is. Because if you just have a lookup table, lender and what score they're using and what time period, you can quickly identify, okay, it's Rocket between this time period, they're sending me Vantage. and I don't need an additional field. And that, of course, adding an additional field doesn't sound like it should be hard, but as you know, Jeremy, adding additional fields for the mortgage industry is like a 7-year process. And so anyway, so I think that solves a lot of problems, but being able to choose what score at a loan level is just, I just cannot see the logic behind it.
Yeah, that kind of is a perfect segue to the second part of this, which is the intent, at least as we were told from the conversations at a high level with the administration, was to help lower the cost of originating a mortgage, help lower the cost to the consumer. And so I did see, back to Director Pulte's tweets, I saw some really interesting ones about the competition between VantageScore and FICO. And are we already starting to see the jostling and the positioning of competition and around quality, around whose scoring model captures more or is a better indicator over large data sets? We are starting to see those competitive angles start to come out. And so I saw the director kind of put those side by side in a tweet. But unless we do the structure the way you just described, that the lender subscribes to a particular or becomes a user of one particular model, we're not actually going to see the competition drive price down. We would in that case, the way you described it. We probably wouldn't otherwise, because if I have the option, I'll pull as much information as I can because I want all my options. I want the best price and I want the fastest approval. So I'm going to just pull them all, take a look at them and pick. And that won't really drive the cost down. It'll drive the cost up.
Yeah, absolutely. And the other comment I'll make, and I think this will be very in character for me to say this, is like thinking about these scores as if like one score being better than another score is going to really help you manage risk is just utter nonsense. I mean, these scores are all really good at measuring risk. They're marginally different. And at the end of the day, that marginal difference is completely eliminated when you start getting truly out of sample into the future. And so I can't really, that as an objective of credit card of the credit score competition it just doesn't make any sense to me. I like the price. I hope the price thing does happen. Again, to your point, if lenders are choosing what score they're going to use, now they're going to get pitched by different credit scoring companies, and they're going to try to really push on price, right? And that even opens the door, hopefully, to new credit scoring companies that can be even more aggressive in their pricing, and that'll be really good. But the other benefit, too, that Pulte's been very focused on is this helping renters. I'm not quite sure it gets us there. Do you think it's really going to change the world for renters?
I don't think it really changes the world for renters. And my reason for believing that is when the GSEs took a look at the different VantageScore models to begin with, prior to this announcement, there was a belief that it was good, but that it wasn't good enough to move the needle enough to get renters' hopes up, if that makes sense. Meaning, looking at the models, it didn't do enough for either eligibility risk or pricing that was meaningful enough to bring it to market. Because I guess I'll frame it this way, John. What I think is good for renters is getting more dynamic monthly payment and cash flow related data into the lending ecosystem. I think that's really important. And I do think long-term, we do want things like VantageScore in the mix because we just need to push everybody, FICO, Vantage, all the underwriting models, all the agency and non-agency loan products, more towards dynamic cash flow related analysis. And VantageScore gets us closer because renters get an easier time reporting rent and getting that to be part of their monthly cash flow. So I think that's, you and I would agree. I think a lot of people would agree that pushes us forward in some sense. The problem is it might be at the expense of getting renters' hopes up that there's a boost or a score or some trended data that suddenly makes them a homeowner and makes it affordable. And the reality is, I think what we're going to find out is no matter what scoring model you use, we're in largely the same place of who's eligible and who wins a home and who gets a home.
Yeah, well said. I mean, we at Bilt do a ton of rent reporting. We're the only like massive free rent reporting platform out there, and we do hundreds and hundreds of thousands of renters. And it's super valuable when we look at it, especially for somebody who doesn't have credit. You get to establish credit, and that's really good. And Vantage definitely has an edge on giving somebody an early score based on limited data. But the first thing I'll say is like those people who don't have any other form of credit and now establish a score aren't the people that are buying homes, right? They're going to have to establish other forms of credit, which they now can do, and that's a good thing. But that's down the road. Otherwise, if you really need a boost to your credit score, you're probably not in the top level of credit scores, so you're probably going to be an FHA borrower at the end of the day. So again, it doesn't really change things. The only thing I'll say, and maybe slightly correct one thing you mentioned, which I think is mostly true, but what we see in the data is that we get about a 10-point bump on average to credit scores when there's rent added to the credit report. At least that we test that with FICO. 10 points is enough for 50% of the time to move you a pricing bucket. And those pricing buckets can be meaningful. So I think, like, at least in my opinion, this is most helpful from a pricing perspective. I have yet to see how they're going to manage to have this flow through to pricing, because capital and pricing grids are all FICO based. If they don't approach that with some innovation and creativity and just try to muscle through it by creating multiple capital standards, multiple grids, it's going to be a mess. It's going to take forever. But I do think there are simpler ways to do it. But I'm holding my breath a little bit here to see if they actually deliver on the real value for renters, which is changing pricing for people that have rent on their credit report.
Right on. And I'll just add one quick end note, which is we do need to find ways to get lenders, platforms, mortgage professionals, real estate agents, reasons and incentives to work with people longer. It's very expensive to work with somebody through that process of getting all of your financial history and your credit history in line, working to boost it, grow it, increase it, and then also add the resources you need to get a home. And it's hard to do that in a transactional environment, transactional industry. So the more we can leverage these things, rent reporting, Bilt, VantageScore, FICO 10T, whatever, to get more founders and entrepreneurs working on that process of nurturing and finding ways to incentivize that and make the economics work to bring people along into home ownership, we got to do it. So we have to be more, creative, and this will at least inject some of that. So just one kind of challenge out there to founders and entrepreneurs. If you can figure out the economics of working with someone, it's going to pay off in a big way.
Yeah, that's a great point. Well, let's move on to the last of the tweet storm, and maybe the oldest tweet of these, which is on crypto. And as far as I can tell, the announcement is that crypto is now a valid source of reserves, I think. But I'm still trying to figure out what we're talking about here. So maybe you can enlighten me on this particular topic.
Well, you had already taken the headline a little, like, one step further to where we know the policy guidelines are. If you don't think about the policy underwriting guidelines, what you saw mostly in the headlines was crypto's okay to pay for a mortgage. Now, that's not what the headline said, but that's what a lot of people thought it said. So people not in our industry reaching out to me after that headline was like, I didn't realize you could use Bitcoin to pay a mortgage. I was like, you can't. That is not what it said. But that was the assumption, or that's how some of these headlines were framed. The reality is exactly what you said, John, which is it an asset? And if it's an asset, can I calculate any of it as part of my assets for the income and assets aspect of underwriting? And the biggest question is, if I'm allowed to count crypto as an asset and its value moves minute by minute, what amount is it worth? Is it worth last minute's amount or next minute's amount? And so the biggest thing that we see in mortgage underwriting, not crypto, is sometimes assets are not given their full value or their paper value or their fair market value. They're given a smaller percentage. In our industry, it's called a haircut, right? So they're given a haircut. You're only allowed to use 60% of that asset or 70% of that asset because it's too risky to be underwritten on. And that's kind of the bucket I put this announcement in, is somebody now at the GSEs has to decide, if we're using crypto as an asset for the income and asset analysis, what value are we going to put it on? Is it 50% of fair market value that day? What market are you using? What are the indicators? And what percentage does it get to be valued? But for people holding a lot of crypto, even 50% might matter. I just don't know how many people that actually is.
When I think about how reserves gets used in the underwriting process, particularly a loan that goes through DU, it's very often not required. I can't think of how many people are like, if only I could count my crypto, would I be able to qualify for this home? So that's probably going to be, the impact is going to be small. What I will say, and I think this administration has done, I'll call it a good job of doing. I think, that'll be, whether or not you should do it is debatable, but a good job of doing is legitimizing crypto as a thing. the fact that it now shows up in federal guidelines around housing, I think starts to move crypto into the world of a normal type of asset that people can just own. And so I think the biggest aspect of this for me is just optics around crypto. And I just don't, aside from some people at Fannie Mae and Freddie Mac having to spend 600 days writing PowerPoint presentations about how to word the crypto thing and what haircut they should use, I don't see what else it's really going to impact.
Yeah, I think that's a good way to end on that topic, which is I think it does do more for the public relations aspects of the headline than anything else. We'll continue to watch. Well, frankly, we'll continue to watch all of Director Pulte's tweets and his feed because there could be a policy announcement at any time. But I think this has shown us that even through the disruption we talked about at the outset, things are moving. People are now reacting and people are now responding. And so that gives, at least from housing pros, housing professionals point of view, it gives us more to think about and do.
So just like we're giving crypto a lot of legitimacy, we're giving social media a lot of legitimacy when it comes to the mortgage market and the importance of following it. But I think let's stop there for a second and take a short break for a word from our sponsor. And then we'll come back for even more fun on social media. Bilt Rewards is a payment platform for housing that rewards members in their home and neighborhood. Bilt is the payment platform for over 5 million units because Bilt provides incredible value to residents and to property owners and managers that use it. Properties using Bilt have seen reduced turnover, increased usage of electronic payments, and fewer missed payments. And with our latest resident loyalty program, Bilt is changing the way that property managers can reward good behavior. Managers can assign rewards and benefits to tenants for a variety of activities like early lease renewal. If you're interested in learning more, go to alliance.biltrewards.com.
Welcome back. This is Housing Insiders. John, you and I have been going through what are the hottest topics, breaking news, or current events that seem to be flooding social media. Social media for us has really tended to mean LinkedIn and Twitter, X, so far. That's really kind of what we're talking about. Obviously, we'll have to do a show at some point about TikTok influencers for housing, real estate, but that's not today's show. One of the things that's been popping up a lot, John, that I really wanted to ask you about, I do have a specific post we can reference, but there is this broad theme of home builders dictating the messaging of how the housing market is doing. That home builders and home builder performance, home builder announcements is actually an indicator that I think I didn't realize was so strong for the media, for Wall Street, and for other researchers and economists to be looking at. And it seems like over the last couple of weeks, we've had a bunch of tweets or posts about how home builders are nervous, home builder confidence is declining, home builder pricing packages, which we'll talk about different components of, but the mortgage incentives, the buy downs, and in some cases even price reductions are indicating apparently to economists that we have a housing problem from an economy perspective, that we're on the brink of a crisis, not the supply crisis that we usually talk about, but the pricing and related systemic risk. Are you seeing that same thing in your feed?
Oh yeah. I mean, it's all over the place. And, I wish I had time to be an economist on the side and to really study these things. Fortunately, we have a lot of great economist friends, and we'll have to have somebody on to actually help us sort through this data. But I think you said something before, which like some of these announcements that we're seeing just feel in some ways kind of unfulfilling. It's just sort of like, I'm not really buying the story here. But it's definitely a story that's being told a lot. And to your point, there are a lot of people in the industry that are seriously looking at this and starting to think about what's happening. And I mean, I know we could talk for an hour. We probably should do a TikTok instead on sort of what is actually happening to home prices. But I mean, the honest answer for me is it's really hard to get a sense of how meaningful these trends are when, I don't know, Fannie Mae's forecast for home price growth this year was like 0.3%, if I remember correctly at some point. So like, yeah, it's expected. We're not going to have 20% home price increase this year. Maybe this is just that finally coming to true. Is that kind of what your sense is, or are you worried that there's something more?
My worry was that I was missing something. My worry was like, I don't have the same spidey sense going off that the Mark Zandis of the world have on their post. Mark's post about, I may change my yellow flare caution to a red flare because I'm that worried about home prices and I'm that worried about the housing market. And for Mark to say that is an indicator to everyone who reads him, who watches him as one of those trusted voices, to say we have a red flare right now in home prices in this country. And so what I was actually feeling was, how come, for those of us talking about it all day, working in it all day, thinking about it all day, why hadn't I heard more concern, or why haven't I seen more of an indicator of that than at that level, the post? And I think one of the reasons is something we talked about, with Ivy Zellman, and about just that this is a highly localized market and an indicator. And so you have to really understand, what does each market mean? But at the same time, I thought, well, I must be missing something. So I started to try to dig into it. And I think the story for me is like, I'm actually not as worried as others, but I do think that 4 or 5 public home builders in 4 or 5 key markets are telling a story that then overshadows or becomes a national trend, when we might be talking about a more specific thing, which is public home builder subdivisions in certain places not being as attractive to buyers as they thought, or as we thought they would have been 3 years ago or 2 years ago when they broke ground, versus we have a real problem with home prices. It's a buyer's market now, and prices are just going down.
Yeah, it's always weird to have to pivot month by month from saying we don't have enough supply in this country and we really need to build more homes, and then actually we can't build any more homes because nobody's there to buy them. I mean, to your point, all this stuff is hyper local. We have all sorts of things happening with property taxes and homeowners insurance and all these other sort of things that are going on. Back to something we talked about earlier, there's a lot of talk about firing the Fed chair and then suddenly lowering rates. And so, if you're a home buyer and you're looking around and hearing all this sort of chaos and like, oh, President Trump is going to deliver lower rates, well, maybe you're going to sit on the sidelines for a little more. And maybe that's an effect that we're starting to see play out. Maybe home builders don't want to do as many buy downs, or maybe I know there's some subtle changes in how like buy downs and other incentives are working and how they're allowed, how big they're allowed to be. And maybe we're seeing some constraints on that. Maybe the home was never worth what it was selling before because it was really only worth that because of the buy down. Anyway, it's just such a complicated issue. It's so local. I kind of agree. I don't feel like there's a red flare, but Mark Zandi is a super smart guy. Chris Doritas, who works for him, just super smart economist. Some of the people that have made comments are economists that I have a lot of respect for. So it's not something you can ignore, obviously. And I guess the question it leads me to, and sorry for rambling a little bit here, Jeremy, but is, okay, there's a red flare, a siren, whatever you want to call it. Home prices are going to go down this year. Maybe they're going to go down 5%. Let's just assume that happens. What does that mean? What are the implications of that for the existing market, for entrepreneurs? Is there anything that we can take away from that?
Well, one of the questions I would ask straight away is the 5% reduction from where we are today meaningful to systemic risk or to the market if most markets went up 30 to 35% over the last 3 years? So are we actually going down 5%, or are we losing 5% of the gains we made since 2022 or something like that? And I think that headline would put it a lot more, or that study would put it a lot more in context. That said, I do want to challenge entrepreneurs or others who are looking at this. How do you stand up something quickly that matches the supposed population of pre-approved underwritten shoppers that all of our mortgage partners tell us they have these big databases of all of these shoppers, all these fully underwritten, already underwritten, pre-approved first-time home buyers, which we're told by the mortgage industry we have this huge amount of. We have this huge database of pre-approvals with their verified approved credit limit letter that they can submit walking around. And apparently we have all builders or other types of sellers who are seeing reductions or having to give away $10,000, $12,000 to close that. How do we match them up then? Okay, so as an entrepreneur, let's do it. Let's start matching up the pre-approval database of the whole industry. Like I would say to the MBA, there's some advocacy right there. You want to advocate for the mortgage industry? Let's do an industry database of pre-approvals that anybody can go look. How many are in my MSA? How many are in my zip code? And if there's a builder who's struggling, are they struggling because they just haven't tapped the right source of potential buyers? Or maybe they're unwilling to. I don't know. But getting to the bottom of that and doing a better job of saying, hold on a second, prices are going down in suburban Dallas, as an industry, we might have 13,000 pre-approvals, 22,000. I don't even know. We may have 100,000 pre-approvals in Dallas. I'm not actually sure. But getting some more advocacy around that for the mortgage industry, I think would actually help at this moment. And it might even move inventory, which is what everybody wants. So I don't know, to your point, what is going to move the needle or if there's an opportunity for founders or entrepreneurs here, but it sure feels like it because there's enough hand-wringing and angst around it online that there must be something here.
Yeah. I think the way I've been sort of thinking about the risk is like, as we know, like if you've got a 90 LTV, you're basically in a break-even position, right? So if you go sell your home after all the costs and so on and so forth, you're probably going to end up walking away with no equity. So the question for me is like, how many people are right there on the line? And now we're going to experience a 5% depreciation, which is going to push them into basically what is truly underwater territory. That's one part of the question, which is like how many loans are actually at risk for a 5 or 10% loss in home price value. But then the other thing about mortgage risk is that it requires a trigger. Like nobody's going to walk away. We know that's nonsense. So like the question is, are we going to see unemployment in these areas? Like, or is there going to be anything that triggers like an inability to pay? I mean, I know we get occasional blips of delinquency here and there out of a function of just sort of macroeconomic factors, but like that's not a lot. I mean, that's not really going to be enough to make anybody really worried. But if we do see a really bad jobs report or a really bad jobs report in some of the markets that we're talking about potentially going under, I think then that sort of says, okay, we might have some defaults. Then where my mind goes, entrepreneur that I am, is like, well, what are the rents in those markets and how cheap can I buy that home for? And now suddenly does an SFR play start to make sense when home prices are going down and rents are going up, just like they did in just after the crisis. So that's another potential opportunity. Or, you know, the last one I'll throw out there is if somebody can't afford their home, like, is there some kind of shared equity structure where somebody buys some of the equity to kind of make it even for them and, you know, buys it at a discount and allows them to stay in their home, or allows them to put an ADU in their backyard to bring it full circle to get some additional revenue. So anyway, there's some of those opportunities that I think really come to the forefront if this is a meaningful trend, if there is something that's actually going to trigger defaults, over the next couple of years.
Yeah, from a wealth creation perspective, it's about time and market, right? And if there isn't a reason to sell that asset, that house, you're just going to hold it till it goes back up or goes back to where you need it to go. So you're right. It's really only a matter of whether my income disappears or whether I had some reason I had to sell that house. But if you bought a house, especially on an FHA loan in the last couple of years, you probably weren't planning to sell it on a 3-year horizon anyhow. So it wasn't something that you had anticipated, but for, like you said, a life event. But most people who are first-time home buyers that we'd be the most concerned with are the most sensitive or vulnerable. They weren't planning to sell that house in 3 to 5 years anyhow. So let's just wait and see what they need. But you're right. If they start losing their job, or maybe we see a shift, we haven't seen AI really threaten wide scale areas of jobs. And so for us, I think last episode was a great summary of it. We think it's going to create more jobs, frankly, not less. But, those types of things where it moves very quickly in particular areas, and those areas are also ones that have the 5 to 10% drop. Sure, but I don't know that we just described an actual area of the country right now.
Yeah, I totally agree. Well, wow, what an action-packed summer. Usually
That's right.
Quiet, but this has been an extremely exciting summer, and it's been a great conversation, Jeremy. I will say it probably is not quite as fun as the conversation we had 4 beers in last night, but certainly a great one. For those listeners who have stuck around, thanks so much for listening in. We have a whole bunch of new stuff coming up, and then we get into conference season. Jeremy and I will be on the road. We'll be a lot of places, and if you want to sort of join us for a beer-driven conversation, please find us at one of these conferences. So that does it for the episode. We'd love to hear from you. Send us an email at podcast@thehousinginsiders.com. And if you like what you hear, we always love it when you leave us a review.
And we don't mind when you tell us you want to be on the show too. So if you want to be part of this conversation on mic or off mic, as John said, please reach out to us. Let us know. And we'd love to hear from you. If you are Mark Zandi or you work for Mark Zandi, Mark, you're welcome on the show as well. And for everyone else.
Called him out. I love it.
Here's hoping. For everybody else who's listening, thank you for subscribing. Please share this, subscribe so that more of this shows up in your feed and we can continue to bring you Housing Insiders. Thank you, Keenan Chen, for the music.